everybody. First week of September. Let's do things a little bit differently today. I want to share my screen with you and take you through some chart patterns of what's been happening in the market for the last month and what we think is going to happen going forward. You know, August and September are typically a pretty choppy period. The market historically is down more than it's up during this time frame. We saw that last month in August. We had a good rebound at the end of August last month. And we're seeing some choppy patterns and choppy trading so far in September. And there's, the reason for that is it's the end of summer. A lot of people are on vacation. There's just not a ton of volume in the market to make big moves or define trends one way or the other. But after September's over, that typically changes, and the market really does decide which way it wants to go, starting, usually with the beginning of October. So, take you through what we're seeing in some chart patterns and what we're thinking is going to happen moving forward, or just at least the options that we're seeing as possibilities of what the rest of the year could look like. So let's take a look at that right now. All right, so let's take a look at the overall market on a chart and see what that looks like. So what we're looking at here is called a candlestick chart. It's a chart type that'll show us the overall direction of the market, but also individual days results or days performance. So just to zoom in for a second, each one of these bars, the green and the red bars, is what we call a candle, and it represents one day. And it also tells us what the results of that day were. So if the candle's green, means the day was green. If the candle's red, means the day was red or down. So we not only see, again, the overall kind of trend of the market, but the results of each individual day, which is helpful to see sometimes. Zooming back out, time frame that we're looking at here is, if we look back at this peak, that's the peak of late 2021, in November when the market kind of topped out, and then this time frame here was 2022. Right here is the start of 2023, and then this is the results of 2023 so far. So you can see 2023 had a big move up in January, had a bit of a pullback in February and March, and then made a bigger move up. And then this is the beginning of August, where we saw a pretty good move down. And then back up towards the end of August. September has been down again. So markets move like this. It's a bit of a choppy thing, but that's the way markets move. The one thing I'll point out a couple things here. First of all, the blue lines here. The blue lines are called moving averages. They're the average price of the market or a stock over a certain period of days. So for example, this bottom blue line here is the 200-day moving average. It's the average closing price of the S&P 500 over the last 200 days. It's a way to average out and smooth out the trend of the market to get a better idea of trend, to kind of see through the ups and downs that the market just does on a daily basis. The line above is the 50-day moving average. It's not as smoothed out because it's not averaged over as many days, but it's also a little more of a real-time reaction of the market because it's less days, so it's more reactive to what the overall market's doing. So what we want to see in both these moving averages is, first of all, we just want to see them both trending up, which is good, which is what they're doing. 200 days moving up really well. The 50-day was moving up. The August kind of stopped the moving up so much, but it's still kind of trending a little bit higher. We don't want to see these moving averages curl over. That's typically kind of a negative sign in the market. We're not seeing that yet, but that's something that we always are watching for. We also would prefer not to see the market pop down through the moving averages. So you can see that the 200-day, the market's still trending well above the 200-day, so that's not a big risk right now. We do see that the market popped down through the 50-day in mid-August, and then kind of popped right back through it, and now it's hovering a bit around it. So that's kind of a neutral indicator. Being well above the 200 days is a pretty positive indicator. The best, for us, we look most probably at trend lines, and trend lines are really important. They're a really good way to gauge kind of what's going to happen in the future of the market, and I'll show you what I mean by a trend line. So if you pick a point, say for this one, for example, and you draw a line, trend lines are points where the market finds support and builds a trend, and one really good indicator of either a downward move or an upward move is when the market, or a stock for that matter, crosses through a trend line or breaks a trend. So you can see that happened in mid-August right here. The market moved down, the trend line didn't hold, it popped through the trend line and then moved a fair amount lower. So that's a big negative indicator. When a stock pops down through a trend line or a trend line breaks, it a lot of times leads to a fairly sharp decline, at least in the short term. That being said, the market bounced, moved back up towards the trend line. And the other thing about trend lines is they often act as support on the way up. But if a market or a stock pops below or breaks a trend line on the way down, a lot of times on the way back up, that trend line now acts as resistance as opposed to support, which is exactly what happened here. The market gets right back to the trend line, moves back down, and now we're kind of in the middle of no man's land. More specifically, if we want to get rid of that trend line and look at a little more short term to look at what might happen in the next week or two, we can draw a trend line from here, moving up, and here, moving down. So both of these are technically trend lines. One's just moving down, one's moving up. And this is a really common pattern called a diamond pattern, where we have essentially the market's chopping sideways, and it's trying to decide what way it wants to go. And especially in months of August and September, where it's the end of summer, there's not a lot of volume in the market because investment professionals are on vacation or whatever, wherever they're at. People are doing other things as opposed to trading stocks. So the volume of the market's lower. It's more difficult for the market to find a trend one way or the other. There's just not that much activity to support it. So a lot of times stocks just kind of chop around. That's what happens here. We're kind of chopping between the trend lines, and we're trying to figure out a way that this thing is going to go eventually. Now, the way this pattern particularly is put together is that it comes to a point, and at the point, the market's either going to break above this trend line or break below this trend line. And that's significant. If we break above this trend line, that's a really good sign for, at least in the short term, more strength in the market going forward. If we drop or if we break this trend line to the downside, that's a more negative sign where the market's showing some weakness. We might see the next couple weeks or a month be a little bit below market averages or below what we'd like to see in the market. So we'll be watching this for the next couple weeks because we will get a resolution for sure, because it's only going to be another, say, 2 weeks before this point has happened, and it's going to go one way or the other. So that's going to, whatever way this thing breaks out, either above or below, is probably going to predict what's going to happen for the following couple weeks after that, or with the direction of the market that's going to go for the next week or two after that happens. Our general outlook is that, somewhat regardless of what happens at this point here, the rest of the year has a good chance of being more positive than negative. That being said, as long as corporate earnings that come out for the third quarter in October are not terrible, at least if they're good, or at least mediocre, it should hold up pretty well. If they're bad, that's going to be a problem for the market. If inflation doesn't keep on going down, which it looks like it will, but if it doesn't, that's going to be a negative thing for the market. But generally, as long as there's no unexpected weak data, the odds of a bit of a move higher for the last quarter of the year are probably pretty good. And then we'll get to 2024, and again, it's going to be everyone's going to be talking about whether there's going to be recession still, and inflation, and the Federal Reserve, interest rate hikes, all that stuff. That it's winding down and it's looking good, but there's always the potential for surprises out there. I want to back out of here, and just to give you one more example of why trend lines are important, or why they're such a good kind of predictor of the next moves in the market. So like this trend line level right here is a very short term, the shorter term trend that we're looking at, the shorter term following move we can expect based on that trend. So like if we're looking at a trend of a month and a half, if the market breaks one way or another out of this short time frame, it probably will indicate the performance of the market for the following couple weeks to a month at the most. It's just not a very long trend, so it's not going to perpetuate a very long move after the trend breaks in one way or the other. But there are longer term trends too. Like, for example, the trend of basically the entire year of 2022. So you can see here, and this is close, but I'm not going to take the time to get it exact. But you can see that this downward trend, point here, hit its head, hit its head, hit its head, then finally popped through that trend line, and that almost to the penny represents the bottom or the reversal of that trend. And from that point on, the market was moving higher as opposed to lower. So that long-term trend that was broken provided the gas or the fuel for a much longer term rally up. So trend lines can be short. That's important just to kind of indicate the next couple weeks, but longer trends breaking. And it's the same thing with when we look at the uptrend from way back here. This was an incredibly long trend for years, which was finally broken, and that indicated a huge, fairly long move down in the market too. So the longer term the trend is, the more durable the result is after that trend's broken. Short-term trends we can use just to predict short-term moves in the future, but each are important. We watch them all on a, for the most part, daily basis to understand, what direction the market might move, and more importantly, though, the longer-term directions of the market based on what's happening there. So we'll follow up with this in our next video next month to see kind of what the results were on what happened here, and see if the indicators are correct and the market actually did move in one way or the other based on what happened here. So we'll cover that then, but hope you guys are all doing well, and we'll talk to you in a few weeks.